Hey guys, so in today's video, I'm going to be teaching you a super simple ICT Forex trading strategy that's called the opening range breakout. Now this strategy is simple, it's mechanical, and so long as you follow the rules that I'm going to give you, I can guarantee you that you'll be able to pass your funded account challenges and you'll be able to get those massive payouts. Now in this video, we're going to break down 3 trade setups so that you can really understand how to frame up these A+ setups yourself. So let's jump straight into it without further ado. And what we're going to do is come onto our charts and identify the first 15-minute candle after the New York Stock Exchange open. Now for me, that is at exactly 2:30 p.m. UK time. Now, wherever you are in this world, if you're not in the UK, then configure it to whatever time zone you're in. But for me, it's at 2:30 in the afternoon. And that is when the New York Stock Exchange opens. So as we can see right here, if I identify this with a vertical candle, that is the 2:30 p.m. opening candle. So we're on the 15-minute time frame. And what we're going to do is mark out the high and the low of that first 15-minute candle. Now what this is going to give us, it is going to give us our opening range. Now after that, what we're going to do is wait for the B of the ORB, is the opening range breakout. So we're going to wait for a breakout of either side of this opening range. But what we're going to do is confluence stack. So essentially, we're going to go up to the higher time frames and see what is the overall narrative. Now, as we can see, once we jump up to the 4-hourly, the overall narrative is that we are bearish. Therefore, what we want price to do is break out to the downside, because then it's in line with the higher time frame trend. Now, if we're always going with the trend, as they say, the trend is your friend, you're going to make a lot more money than if you go against the trend. So what we're going to do is wait for price to break out to the downside. And as we can see right there, we get a breakout to the downside. After that, we're essentially just going to wait for price to come back up and retest right there the opening range low. Now if we broke out to the upside, well, we're going to wait for price to retest the opening range high. But in this scenario, we break out to the downside, so we're going to wait for price to retest the opening range low. Now once we get that retest, we now need a confirmation from price that it wants to go lower. Now we do this by waiting for price to give us a candle which engulfs the previous candle. So this is our current candle high and low. We need the next candle to give us a body closure below this candle's low right here. So if I play price on, do we get that? And we get a massive impulse to the downside. This is price telling us that it wants to go lower. So what do? We take our entry right here at the open of this candle, at the close of that candle. We put our stops just above that high, and we can simply target a 1-to-1 or a 1-to-2. Now stay till the end of this video, because I'm going to be teaching you exactly how you're going to make this strategy even better to get much better risk to reward trades and even have extended targets. So if I continue to play price on, we can see that price then just plummets straight to our take profit. So it's nice and simple. Essentially all we're doing is waiting for a breakout of the opening range, a retest of that opening range, a confirmation that price wants to continue lower, and that's it. It's nice and simple. So that was our very first example, but on this exact same trade, I'm going to show you how we could have got an even better entry with an even better risk to reward. So let's replay price real quick back to the original opening candle. We're going to remove everything off the chart and we're going to start fresh. So where are we? We're at 2:30 p.m. UK time. We've just got the first 15-minute candle forming on the 15-minute time frame. We're then identifying the high and the low of that 15-minute candle. We understand that our higher time frame bias is that we are bearish, so we're looking for a breakout to the downside. So let's play price on and wait for that breakout. Right there, we get that breakout to the downside. Now what we're going to do is wait for price to come back up and retest. And as it does right there, we're now going to drop down to the lower time frames. Now the reason why we drop down to the lower time frames is because they always tell the story of what's happening on the higher time frames. And as we can see, price is creating a series of higher lows, higher highs, higher lows, higher highs. So when we get that 1-minute market structure shift, that's going to tell us that the markets have shifted from bullish to bearish and that they are looking to go to the downside. So what we're going to do is identify our most local high or low right here, and we actually need this to break in order for us to get that market structure shift. And once we get that market structure shift, that is our indication to get into this trade so that we can ride it lower. So let's play price on, and what do we get? We finally get that market structure shift right there. So now that we've got that market structure shift, we're then going to identify the order block or the fair value gap which gave us that market structure shift. As you can see right here, we've got this beautiful order block which then gave us that market structure shift to the downside. So what we're going to do is we're going to take our entry at the open of that order block. We're going to put our stop loss just above that high, because if we break above this high, we've essentially invalidated this entire trend and we are no longer bearish, and then we flip back to bullish. That means we should be getting out of that trade ASAP. Now that we've got our entry and our stop loss, now where do we target? Like I said, you can always target a simple one-to-one, but look how much smaller this trade has now become as opposed to the previous example where we had a massive stop loss and a massive take profit, and it was just much more holding that you had to do. Whereas in this scenario where you're actually waiting for the indication on the lower time frames that price wants to go lower, we've now got a much smaller stop loss, which means we can have extended targets. So now if I play price on, we can see that TP1 absolutely just gets smashed right there. Now from here, where can we hold? I mean, if we continue and go to a 1 to 2, let's see if that would have got hit. And that would have got hit just as quickly. Now from there, would a 1 to 3 have been hit? So if I see right here, a 1 to 3 also would have gotten hit. And as you can see, price is still dropping. But that is the power of lower time frame confirmations, because they indicate to you that the lower time frames have flipped from bullish to bearish, which means you should be getting into that position. Whereas if we again go back up to the 15-minute time frame, we already entered all the way up here, whereas in the previous example, we entered all the way down here. So already we're getting better entries. Now, again, stay for the rest of this video because I'm going to show you how you can make it even better with the next example. But let's jump into that ASAP. For this last example, again, we've come onto our charts at exactly 2:30 p.m. UK time. We've identified the high and the low of the first 15-minute candle that has been formed after the New York Stock Exchange has opened. And now we jump up to the higher time frames to see what is our overall trend. Well, as we can see, we are very heavily bearish. Therefore, again, we only want to look for shorts to be in line with our higher time frame bias. Now, like they say, the trend is your friend, so we don't want to go against it. So we've understood our bias and we've got our opening range. Now we're just waiting for the next piece of the puzzle, which is the breakout. So if I continue to play price on, what we can see is that right there we get 2 attempts to break out. However, both attempts have failed. This means we're not looking to get into any positions because we need a body closure outside of this range and not a wick. Now, if I play the next candle, what you can see is that we do the same thing, but in the opposite direction. We've now taken out the liquidity to the downside, but we haven't closed outside of this range yet. So we're still sitting on our hands and we're waiting for price to give us an indication by breaking out with a body closure. Now I'm going to play price on and we can see for quite a while, we stay inside of this opening range. We haven't broken out, and what we want to see is we want to see a breakout to the downside. Now, eventually, after a while, we do get that breakout to the downside. So now we've broken out to the downside in line with the higher time frame trend. We simply just wait for price to come back up and retest this opening range low. So let's wait for price to come back up. And as it does right there, we're then going to drop down to the 1 minute time frame. And this is where we're going to be looking for our entry. So what can we see? Price is creating a series of higher highs and higher lows, telling us that it is currently bullish. So at the moment, we've got higher low, higher high, higher low, higher high, higher low. So our current trading range that we're inside is this as our high and this as our low. So until we break out on either side, we can't really enter into any positions. So let's continue to play price on, and eventually we chop around for a while, but then we don't get a breakout just yet, and we then finally get a breakout right there. So now that we've broken to the downside, price has indicated to us that it's actually flipped bearish and that we should be looking to get into this market. So now we identify the fair value gap, which gave us that market structure shift. So now that we've got that, we're simply then going to be taking our entry right at the open of that fair value gap. We're going to put our stops just above that high, because if price goes all the way up there, again, it's invalidated this entire trend, which means we should no longer be in that trade. And now this is where things get interesting. Where do we target? Well, for this example, what we're going to do is come back up to the 15-minute, and we're going to take a look at what price is doing. Well, first and foremost, what we can see is that our first and very initial target should be this, because we've got a lot of liquidity resting below it. Then our next target should be below this low right here, because there's again a lot of liquidity resting below it. Then we've got more liquidity below this low, and last and final, we've got this low, which is our main and key low, where there's a ton of liquidity sat below. So we can have all of these as our extended targets. So the first one gives us a nice 1 to 3.5 risk to reward. Then the second one gives us a 5.5. This gives us a 7.3. This gives us a 9.3 risk to reward. So we've gone from taking one-to-one risk to reward trades to now finding higher time frame key areas of liquidity, which we can target after we get in with our lower time frame entries. So now that we've understood all of that, all we simply now do is just wait to be tapped in, and let's see if price goes there. Wow, would you look at that? Price absolutely just dumps straight to our extended targets, and that is a nice 1 to 9 risk to reward. So with this one singular trade, you could have actually passed your entire funded account challenge just by having extended targets. That's the power of the strategy, and that is the power of incorporating the higher time frames along with lower time frame confirmation entries. That's pretty much going to wrap it up for this video. If you guys did enjoy it, then don't forget to leave a like, comment, and subscribe. But on that note, I'll catch you guys in the next video.